The Bank of England voted 8-1 to keep rates at 3.75% this week, but the language around that decision is doing more work than the number itself. Governor Andrew Bailey called it an active hold, not a passive wait-and-see, and that distinction is where the repricing pressure lies. The one dissenter, Chief Economist Hugh Pill, voted for an immediate quarter-point rise to 4%. That split matters because it reveals a committee that is not unified on how long the hold can last. The trigger is oil. Brent crude hit $126 a barrel following reports of potential U.S. airstrikes on Iran, the highest in 4 years. The Strait of Hormuz disruption has effectively closed the BoE's path back to its February projection, 2 cuts priced for 2026, and replaced it with 3 scenarios, each carrying a different rate trajectory. Bailey said he places most weight on Scenario B. Oil peaks but stays elevated for longer. Inflation reaches 3.7% this year. Scenario C, which he did. What made mortgage markets move before the vote was not the decision itself, but the scenario language. Lenders pulled hundreds of products within 48 hours of the Iran escalation and repriced surviving deals higher. Fixed-rate holders rolling off in the next 6 months are now pricing in a materially different path than they were in February. The BoE's own assessment says average mortgage payments are set to rise over the next 3 years under even its central scenario. The capital that rotated out of rate-sensitive UK financial stocks in March, specifically out of NatWest and Barclays ahead of their mortgage rate disclosures, was pricing Scenario B, not the hold at face value. Bailey's explicit framing of the hold as active is an attempt to preserve credibility on both sides, not so tight that growth collapses, not so loose that inflation expectations become unanchored. But that framing is precisely what makes the hold's durability uncertain. The committee has now said it would act forcefully if Scenario C materializes, which means the next oil print above $130 a barrel carries direct MPC tightening risk, not just market speculation.
The April CPI print of 2.8% looked like progress, but the mechanism behind the fall is the complication the BoE cannot ignore. The April dip was almost entirely driven by a temporary reduction in the energy price cap, a £117 cut for a typical household, covering the April to June quarter. The July cap revision is already expected to move higher, as wholesale energy costs from the Iran shock feed through. That means April's 2.8% is likely the cycle low, not a trend. What the headline masks is the pipeline. The Food and Drink Federation has warned food inflation could reach 10% by the end of 2026. Food production is energy-intensive and fertilizer-dependent, 2 input channels directly exposed to the oil price shock. It takes 7 to 13 months for cost increases in the food supply chain to reach supermarket shelves, which means the March to May oil surge has not yet fully printed in food CPI. Services inflation and wage dynamics compound this. Employer national insurance rises and minimum wage increases are already in the cost base, and workers facing higher energy and food costs are more likely to push for pay settlements above the BoE's comfort level. Core CPI fell to 2.5% in April from 3.1% in March, and this is where the MPC's internal disagreement is sharpest. The committee members who backed the hold argued that core disinflation justifies patience. Those who lean toward tightening, Mann, Lumberdelli, Green, see the core figure as a lagging read, not a forward signal. The divergence in their language is not about whether inflation is falling today. It is about whether the second-round effects from energy are already baked into wage and services pricing, or are still incoming. GBP USD settled around 1.3340 this week, pinned between a BoE that cannot cut and a Fed that is also holding. The pair ceiling near 1.3430, the 50-day moving average, held through Thursday's session, with the technical structure pointing to compressed upside rather than a directional break. Sterling's positioning reflects the same ambiguity as the MPC vote itself. The currency is not weak enough to signal a growth crisis, and not strong enough to signal rate hike pricing has become dominant. That suspension is the market's read on Scenario B, probable enough to prevent cuts, not certain enough to price hikes today. The question the next oil print will answer is whether that suspension breaks towards C.
While rate-sensitive UK financial equities repriced downward and the broader FTSE 100 traded in a narrow range near 10,507, one domestic midcap move this week inverted the pattern. Ocado surged after announcing a partnership with Asda to deploy the Ocado Smart Platform across Asda's UK e-commerce operations, covering webshop, in-store fulfillment, and last-mile logistics from 2027. The shares jumped 13.5% on the day, extending the FTSE 250's weekly gain against the flat-to-weak FTSE 100. The deal is structurally significant because it follows Ocado's partnership collapse with Kroger in the U.S. and marks a pivot back to the domestic market. Analysts at AJ Bell noted the move provides some much-needed good news for a company whose shares remain more than 90% below their 2020 peak. Retail positioning in Ocado had been overwhelmingly short or absent through 2025 and into 2026. The 13.5% move on deal day reflects short covering as the primary initial driver, not fresh long accumulation, a distinction the price action itself evidences through the sharp spike followed by a partial fade. The Asda angle matters separately. Asda is fighting for market position against Tesco and Sainsbury's at a moment when its own competitive standing is fragile. The OSP integration is an operational bet, not a technology luxury. Asda needs to replace its existing e-commerce infrastructure quickly, and Ocado's end-to-end platform is one of the few available at that scale domestically. No financial terms were disclosed, which is why Ocado itself confirmed no material FY26 financial impact. The market reaction priced the strategic signal, not the earnings change. The Ocado move is the one data point this week that does not fit the rate pressure frame, which is exactly what makes it a monitoring variable rather than a trend signal. If the BoE does shift toward tightening under scenario BRC, discretionary consumer spending faces a second compression on top of energy costs, and Ocado's grocery delivery model sits at the intersection of both. The question the deal raises is whether Ocado's e-commerce pivot can sustain its re-rating if the UK consumer's disposable income continues to erode, and the July energy cap revision is the next observable input on that question. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.